Hey everyone, welcome back to Corporate Decoder. Today, we're diving into the financial depths of the Manulife Private Credit Fund, and let me tell you, it's not just another dry read of numbers. It's more like a financial suspense novel, where we try to figure out if this fund is setting the stage for a blockbuster performance or a plot twist no one saw coming. So what is Manulife Private Credit Fund all about? In simple terms, it's a company that lends money to other, usually smaller companies. They aim to give investors returns through the interest they make on these loans, and sometimes, if the company they lent to does really well, a little extra profit. This fund is relatively new, formed in early 2023, and they play in the world of what are called business development companies, or these BDCs are kind of like venture capitalists, but instead of investing in startups, they mostly lend to already established but still growing businesses. The fund's main goal is to create the best returns for its investors, seeking income and capital appreciation. They primarily invest in the debt of middle-market U.S. companies, focusing on first and second lien loans, and sometimes making equity co-investments in these companies. Now, a key thing to remember is that this isn't your typical stock. It's not traded on the stock market, which means it's less liquid. The fund offers what they call Class NAV shares, and they sell these on a continuous monthly basis at a price that matches the fund's net asset value, or NAV, per share. It's like buying directly from the source. To get the ball rolling, Manulife themselves, through some of their other companies, put in about $41.2 million, which they call the seed contribution, in July 2023. Then they bought an initial portfolio of loans, which they called the seed assets, worth about $50 million. Now, this is where it gets a little complex. The fund doesn't manage itself. It's run by an external advisor, Manulife Investment Management Private Markets, which is part of the larger Manulife group. They're the ones picking the investments and running the day-to-day operations. The investment advisory agreement outlines that the advisor has authority in portfolio selection, due diligence, and overall strategy of the fund. The fund also has a service agreement under which Manulife provides accounting and treasury services, and JHIM provides financial reporting, compliance, and service provider oversight. As of the end of 2024, this advisor was overseeing about $51.2 billion in assets. So they're not exactly new to the game. Now, here is where things get spicy. The fund pays the advisor a fee, and this is where we need to pay close attention to see what incentives are at play. There is a management fee, which is a percentage of the fund's assets, and an incentive fee, which is a cut of the profits. The management fee, after a temporary reduction, sits at 1% of the fund's monthly net assets. The incentive fee is split into two components, based on income and capital gains. The incentive fee based on income is determined by comparing the fund's returns to a hurdle rate of 6% annually. If the fund beats this hurdle, the advisor gets a piece of the action. The second piece is based on capital gains and equals to 12.5% of cumulative realized capital gains, net of losses and unrealized depreciation. Looking at the investment strategy, the fund aims to put at least 80% of its money into senior loans. These are loans that are usually the first in line to get paid back if the company runs into trouble. But don't let senior fool you, they still come with risks. At least 70% of the fund's assets must be qualifying assets, and they may also opportunistically invest up to 30% of the portfolio in non-qualifying assets, such as non-US companies. Now, what if you, as an investor, want to cash out? The fund does offer a share repurchase program where they might buy back your shares, but it's not guaranteed and it is not always available. This is not your typical stock that you can sell anytime you want. The plan is to offer to repurchase up to 5% of the outstanding shares, quarterly beginning no earlier than 2026. The fund may co-invest with other funds managed by the advisor, so long as independent trustees deem the arrangement reasonable and fair. There is significant competition to make the types of investments that the fund seeks from other BDCs, private equity, and traditional financial service providers, which means higher risk and reduced returns. The advisor has agreed to limit the amount of the fund's expenses to 0.5% of the monthly net assets through October 3, 2025. This is meant to keep costs reasonable as the fund grows. The fund will calculate the net asset value of its shares monthly. A valuation designee is responsible for determining the fair value of the assets under the oversight of the Board of Trustees. It is important to note the report contains forward-looking statements about future expectations, which are not guarantees of future performance. Of course, this wouldn't be a corporate decoder analysis without looking at the risks. There are many, but here are a few key ones. The fund is new and doesn't have a long track record to prove its strategy. That alone involves risks. A significant portion of investments is recorded at fair value, increasing uncertainty around their actual value. The fund may be unable to pay distributions, and the distributions, if any, may decrease over time. Using borrowed money leveraged to increase returns magnifies the potential for losses, increasing the risk of investing. Also, the common shares will have limited liquidity and may have restrictions placed on transferring them. The economy can always change. Some risks are changes in the general interest rate environment, general economic, political, and industry trends. One thing I noticed is they tend to make investments in loans that may not be fully collateralized, which leads to further speculation. Also, watch out for the section on affiliated transactions. You always want to be on the lookout for potential conflicts of interest in these structures. On the topic of debt, on March 26, 2024, Manulife Private Credit Fund SBV LLC entered into a loan and security agreement that provides a secured credit facility of up to $150 million. Each of the fund and the advisor has adopted a code of ethics under Rule 17J1 of the 1940 Act, collectively the Ethics Codes. Rule 17J1 and the Ethics Codes are designed to prevent unlawful practices in connection with the purchase or sale of securities by covered personnel, access persons. Let's check out the numbers. At the end of 2024, the net asset value per share was $20.80 compared to $20.74 the year before. So, a slight increase there. The increase in net assets from operations went from about $3 million to $8.8 million, indicating a significant jump in profitability. Looking at the income side, total investment income jumped from $2.6 million to $12.7 million, driven by the fund's deployment of capital and invested balance of investments. Total expenses also increased from $1.1 million to $5.3 million, but a good portion of this is offset by expense reductions. To maintain its status as a regulated investment company, the fund must meet certain annual distribution and income requirements. Finally, we have cybersecurity. Similar to other public companies, the report mentions that affiliated business lines have experienced threats to their data and systems periodically, including malware and computer virus attacks, but that hasn't had a material effect. So what's my take on all of this? Manulife Private Credit Fund seems to be playing its cards right. The team seems solid, and the performance shows they know how to generate income and manage their investments, although past performance is not indicative of future results. The significant revenue increase, along with the management and the expense reimbursements, are good indicators of how the fund is growing in terms of performance. The elephant in the room is definitely those debt levels. While leverage can boost returns, it's a double-edged sword. If those investments don't pan out, that debt could become a major headache. And with the share repurchase program not guaranteed, getting your money out might not be as easy as you think. All of this is what we expect from such a company with this type of investments. Overall, this fund could be a good fit if you have a higher risk tolerance, a long-term investment horizon, and you truly know what you are doing. Thanks for watching. If you enjoyed, please subscribe, like, and comment.